In 2001, Hertz reported that ancillary fees, charges beyond the daily rental rate, accounted for less than 12% of revenue. By 2006, that figure had tripled. The decision that unlocked this growth wasn't about raising prices. It was about hiding where the real cost lived. By the late 1990s, the American car rental market was dominated by three companies: Hertz, Enterprise, and Avis. Together, they controlled 70% of airport rentals. The product was simple: a car, a daily rate, insurance if you wanted it. Margins were thin but predictable. The business model had remained largely unchanged for decades. Customers compared advertised daily rates, chose the cheapest, and paid what they expected. Fleet costs, insurance, and maintenance were built into the base price. Profit came from volume and utilization rates, not from surprises at checkout. Hertz, founded in 1918, was the market leader. It operated the largest airport fleet in North America. Its brand meant reliability. In 1999, Hertz posted $1.8 billion in revenue, but return on assets hovered below 4%, low even for a capital-intensive industry. Then the pressure began to build. Ford, which had acquired Hertz in 1987, was losing patience. The parent company wanted better returns. Meanwhile, online travel agencies like Expedia and Priceline were launching price comparison tools that made the rental car market brutally transparent. Customers could see every competitor's rate in seconds. This transparency triggered a race to the bottom. Companies began advertising aggressively low daily rates to win the top spot in search results. A $29 per day rate became $19, then $15. But fleet costs hadn't changed. Every dollar cut from the advertised price came directly out of margin. By 2000, Hertz's operating margin had compressed to 2.1%, according to SEC filings. The company was caught between customer expectation of low advertised prices and the immovable reality of fleet depreciation, insurance premiums, and airport concession fees that could run 30% of revenue at major hubs. Leadership faced three strategic options. First, raise base prices and accept lower market share, a defensive retreat. Second, cut costs by reducing fleet quality or exiting expensive airport locations, operationally risky and brand damaging. Third, redesign the pricing architecture itself to separate the advertised rate from the actual transaction cost. The third option had precedent. Airlines had begun unbundling ticket prices in the late 90s, separating baggage, seat selection, and meals into separate fees. The advertised fare could stay low while total revenue per customer climbed. Hertz executives, according to industry analysis published in Automotive Fleet magazine, saw an opportunity to apply the same logic. In 2001, Hertz implemented a new pricing structure. The base rate remained competitive, often the lowest in search results. But at the point of sale, customers encountered a cascade of separately itemized fees: airport concession recovery, vehicle licensing, energy surcharge, and additional driver fees. Each was presented as a cost pass-through, not a profit center. The naming was deliberate. Terms like concession recovery fee and customer facility charge sounded regulatory, unavoidable. In reality, many were discretionary markups. A 2005 analysis by the American Automobile Association found that these fees, while sometimes based on real costs, were typically set well above the actual expense incurred by the rental company. From Hertz's perspective in 2001, the decision was economically sound. Airport authorities genuinely did charge concession fees, sometimes 20 to 30% of gross revenue. Energy costs were rising. Advertising a $30 rate while explaining that the final cost included legitimate pass-throughs seemed more honest than hiding everything in an inflated base price competitors could undercut. Moreover, Hertz couldn't unilaterally raise advertised prices while Avis and Enterprise remained low. The new structure let Hertz stay visible in price comparison engines, critical for customer acquisition, while recovering margin at checkout when the customer had already arrived, often with no practical alternative. The decision wasn't predatory, it was survival in a market where transparency had become a liability. The results were immediate. Within 18 months, ancillary fees accounted for more than 20% of Hertz's total revenue per rental, according to investor presentations from 2003. Crucially, customer acquisition didn't collapse. Search rankings held. The low advertised rate still won the click. The fees appeared only after commitment. At the rental counter, staff were trained to present fees as mandatory or regulatory. Customers, often arriving after long flights with tight schedules, rarely disputed the charges. The psychological dynamic was asymmetric. Walking away meant rebooking, waiting, and potentially paying more elsewhere. Acceptance became the path of least resistance. Hertz added a second layer: discretionary upsells presented with urgency. Prepaid fuel, GPS units, toll transponders, premium insurance tiers. Each was framed as convenience or protection. Industry training materials, later reviewed in consumer protection lawsuits, instructed agents to emphasize risk. What if you're in an accident, rather than probability? The economics were staggering. A GPS rental might cost Hertz $8 per device per month in depreciation, but rented at $13 per day. Prepaid fuel was sold at 10 to 15% above pump prices. These weren't incidental. By 2006, Hertz disclosed in SEC filings that ancillary revenue had grown to represent 36% of total revenue, a threefold increase in 5 years. But the strategy carried a hidden cost. Customer satisfaction scores began to decline. A 2007 J.D. Power study found that rental car companies ranked lowest in transparency among travel service providers. Online reviews filled with complaints about surprise fees. The brand equity Hertz had built over decades, reliability, trust, was being quietly liquidated for short-term margin. Hertz's competitors watched the revenue growth and faced a choice: match the model or lose margin. By 2004, Avis, Enterprise, and Budget had all adopted similar fee structures. What began as one company's response to pricing pressure became an industry standard. The race to the bottom on base prices continued, but now everyone made up the difference at checkout. The widespread adoption drew regulatory scrutiny. In 2012, the U.S. Federal Trade Commission proposed rules requiring all-in pricing for car rentals. The industry lobbied against it, arguing that itemization provided transparency. The FTC ultimately issued guidelines but stopped short of mandatory bundling. The fee model survived largely intact. By then, the financial architecture of the industry had fundamentally changed. Fleet financing models, investor return expectations, and airport concession agreements all assumed the ancillary revenue stream. Returning to transparent all-in pricing would require a coordinated industry shift, a prisoner's dilemma, where the first mover would lose market share to competitors still showing lower advertised rates. The decision Hertz made in 2001 didn't destroy the company. It transformed the industry. What was once a straightforward transaction, rent a car, pay a daily rate, became a multi-stage revenue extraction process. The advertised price became a fiction, a marketing tool divorced from the actual cost. And because every major competitor adopted the same model, customers had no escape. As of 2023, ancillary fees and upsells represent between 35 and 40% of rental car industry revenue, according to market research firm IBISWorld. Hertz, now independent after multiple ownership changes, continues to rely on the pricing structure it pioneered. Recent attempts at transparent pricing by smaller competitors have failed to gain traction. The model is entrenched. Even as ride-sharing and car-sharing services have grown, the rental car fee model remains resilient. Customers who need a car for several days still turn to traditional rentals, and once there, face the same fee cascade. The infrastructure, airport contracts, fleet financing, revenue management software, is all built around it. Dismantling it would require rebuilding the entire economic foundation. Consumers have adapted, but not by avoiding rentals. Instead, they've learned to navigate the fee structure. Decline the insurance, refuse the GPS, return the car full. Online forums and travel blogs now function as informal guides to minimizing charges. The relationship has become adversarial, a negotiation rather than a transaction. Trust, once lost, hasn't returned, yet the industry remains stable. Hertz, despite bankruptcy in 2020 during the pandemic and subsequent reorganization, emerged with the same pricing model. Enterprise and Avis continue to thrive. The decision that looked like a short-term margin fix in 2001 became the permanent architecture of an entire sector. No one has found a way back. The lesson isn't about deception, it's about pricing power and competitive dynamics. When an industry becomes commoditized and transparent, companies will find ways to obscure comparison. The decision to unbundle pricing can be individually rational and collectively destructive. Once one player succeeds, everyone must follow or fail. And when the entire market shifts, there's no going back, even when everyone, including the companies, might be better off under the old model. What Hertz discovered in 2001 wasn't a loophole. It was a new equilibrium, one where the advertised price and the real price could permanently diverge, as long as every competitor did the same. The decision didn't kill the company. It made the industry unbeatable, and the customer ultimately captive. That pricing decision, made under pressure in a commoditized market, created a business model that proved impossible to undo. The structure remains not because it's optimal, but because no single competitor can afford to be the first to abandon it. Sometimes the most durable transformations are the ones no one intended to be permanent.